Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for Q1 of 2014. My name is Nicholas Basso, and I am a Portfolio Administrator in Ironwood's Investment Division. Tonight, it is my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, please feel free to type them into the questions box on the GoToWebinar panel on the right side of your screen. We will do our best to address all questions at the very end of the presentation. And now, without further delay, please join me in welcoming Sean to lead this evening's presentation. Sean.
Thanks, Nick, and welcome everyone to this edition of the Ironwood Quarterly Market Insight. We're coming off of a great year in 2013 for domestic equities, and we're heading into what has appeared to be a pretty volatile year in 2014, nothing like 2013. In fact, we've seen more volatility so far in the first month of 2014 than we did the entire year of 2013. So I do want to go through some stuff tonight, and I want to dig into how asset classes performed in 2013, what we see is in the current environment, and how that has an impact on some of our investment recommendations and investment decisions going forward. So without any further ado, I'm going to go ahead and jump in. First, we need to make sure we pay our attorneys. Starting this slide off, emotions and investing usually make a very dangerous combination. In 2009, 2008, and early 2009, a lot of investors went through this emotional roller coaster. They went through denial, fear, depression, panic, capitulation, despondency. We had clients coming in, they wouldn't even look at their statements. It's hard to get somebody to invest right here, but it's actually the safest time to invest is as long as you have a long-term approach. Fast forward a few years, we've kind of gone through depression, hope, relief. I would say we're probably somewhere in the optimism to excitement level. Clients are coming in, we're starting to hear, okay, well, the market was up 30%, how is my account doing? And so you're starting to hear those optimistic phrases, excitement again, and we're kind of through the doldrums of the 2008-2009 recession. I bring this slide up only because I believe we're in about the fourth or fifth inning of this next cycle in the market, and I just want to make sure that everybody realizes that, hey, it's not as easy to make money when we're here as it is when we're here. When we're here, the market is very dislocated. There are some very opportunistic things we can do with the portfolio. It makes my job managing the portfolio fairly easy, fairly cut and dry. It makes dealing with people a lot harder, but managing the portfolio is a lot easier here. Once we get to this level, now the market's a little bit more fairly valued. Now it's a lot harder to do the asset management side of things, but it's a lot easier to manage people's expectations. So, there's a double-edged sword there. But I just bring this up because you will start to hear me say, I've been a very big proponent of equities while we've gone through these stages here, and it wasn't fun. But now that we're getting up to the relief and optimism and excitement and thrill, you'll start to hear me talk about, okay, well, maybe now we need to look at some other areas in the market. We definitely never want to abandon equities or abandon bonds or abandon any one area of the market, but we might put a little less emphasis on some areas. But like I said, I think we're only in the fourth or fifth inning of a 9-inning baseball game here, and we still have some way to go. So I want to get through some of this stuff. To kind of put it into perspective here, we've looked at this graph in the past, so we've updated it. through the end of 2013. You know, when I prepared these slides, I really did it at the, earlier in the year, before January really happened. So, my story to everyone was going to be, okay, well, at 1848 on the S&P with a 15.4 multiple and a 2% dividend yield, treasury rate at 3%, we're starting to get more fairly valued. We're starting to get there. Now, that doesn't mean that we'll stay there. It doesn't mean that stocks are a bad investment at fairly valued. It just means we're back up to where we should be, and that you could still look at other periods of time and know, okay, well, in 2007 we were pretty fairly valued, and then we had the financial crisis hit us. It's going to be hard for another financial crisis to hit us right now with where banks are leverage-wise, with going through what we went through. It's a lot harder to imagine something derailing us like that. But in 2000, we were, at 15.27, PE multiples way above where they should have been, dividend yields way below where they should have been, and a 10-year Treasury that right now, if we could buy a 10-year Treasury at 6.2, there'd be a lot of happy people out there. But unfortunately, we're at 3. Actually, we're at 3 at the end of the year. Now we're less than that. So now, a month into it, I have to kind of change my story a little bit because markets have gone down about 7% on the S&P, and now our PE multiple still looks a little bit below where average, or not average, but a little bit below, a little bit undervalued. So, and dividends are still around 2%, but the 10-year Treasury has fallen from 3 to about 2.7. So a little bit different story, but you get the idea. I still think we're heading toward this more fairly valued in stocks, still probably overvalued in fixed income because we do keep seeing increased interest rate environment due to positive economic outcomes. But just to put this in a little bit more grand scale, when we look at this chart here, it's like, okay, well, it's kind of a big roller coaster right here. When are we ever going to get out of this trading range? And then you can kind of look back in history, and this has happened before, where we've had these long periods of we don't really go anywhere, and then some periods of up, period of not really going anywhere, period of up, period of not going anywhere, period of up, period of not going anywhere. These periods of not going anywhere really let earnings catch up, and that will prove to be the next springboard for the next increase in the S&P 500 in equities. So I just wanted to show this slide here to put things into a bigger perspective versus just looking at this slide here. One thing to point out, we are up 173% since the market bottom, March 9th, 2009. Last year was a phenomenal year. Domestic equities were up 30%. In the fourth quarter, the S&P was up 10.5%. The small cap U.S. sector was up 8.7%. International did slightly worse than that. Developed was up 5.7%. Emerging markets were only up 1.9%. The last fourth quarter, we saw an increase in the 10-year Treasury from 2.61 to 3.04. ISM numbers were very strong in the fourth quarter of last year. Both manufacturing, non-manufacturing, they looked very positive. The U.S. job market continued to improve in line with the rest of 2013, where we've seen the unemployment rate drop by 1.1% over 2013. So that was the fourth quarter. Now if we look at the 2013, the entire year, we can see that domestic equities did very well. S&P up almost 33%, just over 32%. Small cap up almost 40%. International equities definitely underperformed. We'll talk about this a little later, but developed international was up about 23%. Emerging markets actually lost money during the year. The 10-year Treasury was increased 124 basis points. 128 basis points from 1.76 to 3.04%. This made, because of this interest rate increase, the global bond index was actually down almost 3% for 2013 total return. So that's income plus price depreciation. Bonds lost about 3% for the year. The unemployment rate, like I said, went from 7.8 to 6.7. We'll talk a little bit more about that and the implications to maybe the Fed tapering. Confidence came back with a vengeance. Net worth for U.S. Citizens was up $8 trillion. And if you combine that with 2012 we saw $6 trillion. So combined $14 trillion over those 2 years. That's a tremendous amount of net worth being created over a very short period of time. That has a lot to do with why confidence came back into the marketplace. I want to spend a little bit of time with this slide. This is a new slide that I actually added into the presentation. This is 2013's risk versus return. You can't really see all of these symbols here, but we've got global real estate at about 3 or 4% return with about 13% standard deviation or risk. We have emerging markets, which actually lost about 3% for the year and took 14% standard deviation. We had commodities lose almost 10% for the year with about a 10% standard deviation. And then we had the two equity indexes. So this is domestic, and this is large or developed countries that are outside the United States. So you can see these two equity benchmarks did very well. S&P up 32%, EFA up 23%, with a moderate level of risk. All of these asset classes here had about the same level of risk. However, you would have been a lot better off in the S&P 500 or developed international than you would have been with global real estate or emerging markets or commodities. Global bonds, like I said, they lost about 3%. You took a little less risk in your global bond portfolio, but you lost return. So unless you were 100% S&P or 100% a combination of S&P and developed international, you are going to have some of these things in your portfolio which are going to bring down your return. But hopefully combining all of these asset classes will also bring down your risk. So everyone's worried about this return number. They want their portfolio to be as high as possible on this graph over here. But what we forget sometimes is that we're taking a level of risk to get there. And we really want to make sure that we know what level of risk we're taking, because if we take too much risk and we have a bad market like 2008, it can really devastate our financial plans. And that's something that we definitely don't want to put on the table. We want to make sure that everyone's comfortable with their portfolio. That's why we spend so much time going over risk and figuring out what clients are comfortable with and what type of risk they're able to actually make. So that's 2013 in a nutshell. You can tell, okay, well, equities did really well, alternative investments did a little bit worse, and bonds didn't do very well at all. And then just to reiterate this, small caps up 40% almost, S&P's up 32.5%, developed internationals up 23%, market neutrals up 8%, REITs were up 3%, cash is up 0%, bonds, domestic bonds are down 2%. If we look at global bonds, they're down more like 3%, emerging markets down 2.5%, and commodities almost down 10%. So very, very divergent returns for the year. And as an asset allocator, that's a lot better for a portfolio, because you can really reduce the volatility of the overall portfolio by adding all of these divergent categories into the portfolio in a very smart, prudent way, so that you can reduce the overall volatility of the portfolio. In 2013, one of the reasons that equities did so well, the economy definitely improved. Especially in the second half of the year, we saw GDP at 4.1% for the third quarter, and we saw GDP the first estimate at 3.2% for the fourth quarter. In those numbers was a headwind from government because we went through the sequester and the fiscal cliff. So those were headwinds that the economy had to push through, and not only did the economy push through them, but it pushed through it very well. And we believe that the government created about a 1% headwind for GDP. In 2014, GDP looks to grow at about 3 to 4%. One of the reasons that we're in this camp is because we're not going to have that government headwind anymore. Year over year, the government's going to be more like a no wind at all, very calm and not really taking away from GDP in 2014. But you can see here we've recovered all and then some from the recession, and you can kind of see in history, okay, well, these things tend to run long before we have recessions that are in between. So, we're still below trend line growth, but you can see that more recent history, if you take the last 20 to 30 years, we have a little bit lower trend line. That has to do with some of the demographics that the U.S. is facing. A lot of baby boomers retiring. We don't expect the speed limit of the economy to be this 3.1% going forward. It's more like 2.5% over the last 25 years versus the previous 20 years from that. It was, almost 4%. You can kind of see it here in these peaks and valleys, but you can see that the peaks aren't as high over here, but they last a lot longer. So, our economy has definitely changed, and one of the reasons is demographics and the population shift. One of the reasons that we also believe that GDP is going to be between 3 and 4% are these cyclical sectors here. Autos are up above 16 million. We haven't seen that since 2007. Housing stalled a little bit as interest rates increased. That's to be expected, but it's still improving. This recent downturn in interest rates will continue to help housing. Inventories are tight as a drum. Real capital goods, we've seen a pretty good uptick in 2013. You can see that. Oh, sorry about that. You can see that here to the increase at the end of the year. So these are very positive signs for the U.S. economy. Another positive sign is the consumer, which makes up 70% of the GDP for United States. Net worth is up 14 trillion over the past 2 years. I talked about that earlier. That is very, very good for confidence. Household debt service, very low still. Home affordability, very positive. These are all things that are going to impact the consumer in a very positive way and help that C part of the GDP equation improve. Consumer confidence, we've increased about 10 to 20 points in the last 2 years. And once again, that should help the C part of the GDP equation. If you remember from Econ 101, GDP equals C, which is consumer spending, plus I, which is investment, plus G, which is the government. Hopefully the government will get out of our way a little bit this year, plus net exports. So that C, between this slide and consumer confidence, we believe that C is going to be a big part of GDP growth this year, and we can see some improvements because of a stronger consumer. We talked about the G. Here's what I was talking about. These are actually these estimates from the CBO are a little old. We actually are a little bit less than 4% for 2013. The deficit was below 4%, and we were above 7% the year before. So we've literally dropped 3 to 4% in the deficit in a single year. That was painful to do, but the economy, not only did it get through it, but we also grew the second half of the year at over 3%. So 2014, if we can continue that with less government headwinds, that should be a very positive phenomenon for GDP. That's all I really wanted to go over with that slide. Employment, we've got a big employment number tomorrow. I don't think I touched on this at the beginning, but one of the reasons the market's kind of pulled back here, there's a few reasons why. One, in 2013, you go up 32% in the S&P 500, and domestic stocks did really well. International stocks did really well in the grand scheme of things. You don't need that big of a reason to sell when you have that up of a year. And we'll talk about rebalances, and we'll talk about some other things here later. But anything that starts to look a little bit less attractive, or a little hesitation in the economy, people start to question. So employment for December was 74,000, which is very, very low compared to the trend line of 180,000 for 2013. So that started to cause a little concern. Then we had a slowdown in China. Some of the ISM numbers slowed down a little bit. They're still in expansion mode. They just slowed down a little bit. That's to be expected when you have an economy. I mean, you can't just have the economy go up every single month. You're going to have some exhales and some fresh breath into the economy. You're not just going to keep going up in stair steps. So they do happen, but we do want to make sure that we're taking a look at this. Tomorrow we get another jobs report. Today we got a little bit of on Wednesday we got a little glance on this with ADP, and it looks like if we were to look at ADP as any sign of what's to come tomorrow, it looks positive, but ADP and the employment report don't always correlate. But tomorrow, the report will probably be market moving. If it's weak, we could see a little bit of a sell-off just because we went up 30% last year. People are looking for a reason to sell off. If it's positive, well, then this 7% sell-off that we've seen, we possibly go to new highs after that because folks aren't as concerned about the slowdown. And one of the other reasons that I forgot to mention this was some of the emerging economies, some of the small emerging economies had some currency problems, had some liquidity problems. These are tiny emerging markets. We're talking Argentina, we're talking Turkey, and some of the smaller ones. I heard somebody say the other day that if you add up all of Argentina's their cap weight of all their stocks in their stock exchange, it is less than the cap weight of Yahoo. So in the grand scheme of things, they're not really that important to the U.S. economy. But when you go up 30% in a year, people are looking for a reason to sell, and so it's human emotion. It's people trying to get ahead of things, and so that's why you see these volatile periods like we've seen in January. But tomorrow is a very important report. We'll be watching it very closely tomorrow. We are expecting a decent report. Around 180,000 new jobs created is what the consensus is. So we'll definitely want to keep an eye on that. Inflation, not a big concern. Velocity of money has actually kept going down. We believe there's deflationary pressure until we start to see employment growth and significant employment growth and wage growth. Inflation probably won't be that big of an issue. It's been less than 2% for the last 4 or 5 years. So I don't want to spend a lot of time on inflation because it's not really an issue right now, but it doesn't mean that 6 months from now we start to see good economic conditions, interest rates go up, inflation goes up. We want to make sure that the portfolio is protected for it. I just don't want to spend a lot of time for it today in our presentation. Interest rates, I do want to spend a lot of time on interest rates and the Fed and QE and kind of what the Fed has been doing. In 2013, like I said, we saw 10-year treasuries increase by 128 basis points. And you can see the negative real yield that we had. So you take the nominal yield of the 10-year Treasury and you subtract the inflation rate to get your real yield. We had a negative real yield, meaning folks were willing to lose purchasing power and put their money in treasuries and buy less things, guarantee themselves to buy less things 10 years from now in this period of time where we had negative real yields. That doesn't happen very often in history. You can see back into the 50s, it's only really happened 1, 2, 3, 4 times. And it doesn't happen for very long. And you can see we've had a pretty good improvement in rates since then. At the end of the year, we were at 3.04. Currently, in January, we've had a little bit of slowdown in economic conditions and some slowdown around the world. So we've actually seen a flight to quality, which has pushed rates back down to 2.7. In an economic expansion, you're going to see rates go up and then rates kind of come down, but they don't get back down to the lows that they saw. You start to see stocks reach new highs and then they go down, but they don't go past where they went before, and then they reach new highs and they come back down, but their lows are still higher than the previous lows. And then on interest rates, it's exactly opposite, where you get back down, but you don't go all the way down, and then you go back to a new high on interest rates, and you keep doing that as the economy, as data keeps coming out, and it's good and then sluggish, and then good and then sluggish, and we kind of see that back and forth. That's why we never really want to abandon our fixed income portfolio, because it's given us a really, I mean, we rebalanced all the portfolios in late December and early January, and lo and behold, we were selling stocks, we were buying emerging markets, we were buying REITs, we were buying bonds with the proceeds from those stocks that we sold. And in January, the things that did well were the things that we were buying that did horrible in 2013, and the things that we sold, the stocks that had done really well in 2013, started off the year not doing so hot. So when we rebalance, it's forcing us to sell high and buy low, and that's really what we want to do. And to rebalance those portfolios, that's a disciplined approach to doing that. So this was interest rates. We did see a pretty significant uptick in the interest rate space. One of the reasons that we've seen this is because we have a Fed that has now said, okay, we're going to start to taper quantitative easing. So we've talked about quantitative easing in the past. I heard a great example, and I want to go through this example. Another economist that we follow talked about this in one of the talks that I heard, and I thought it was a really good way to describe what the Fed's doing right now and pushing on its strings. So I wanted to kind of go through that example. But really, the Fed has been printing money, buying treasuries, and buying mortgage-backed securities to create liquidity in the system. However, the money multiplier, or the velocity of money, has decreased significantly since they began this program, meaning banks aren't lending this out to clients, and consumers are not going out and spending this money because they can't get loans, because banks aren't loaning money out. So the economic activity that it's creating is really on the margin. And the economist that we follow, Jim Paulson, he gave us an example, and you can kind of see it here. This is where we began the $85 billion per month every month. And you can see the assets of the Fed have been going up, and the liabilities have also been going up about the same exact amount. And what has been going up is the excess reserves that are bank reserves that are that have been given back to the Fed. And so they're a liability to the Fed. The Fed's got to give those back to the banks, and they're buying the treasuries and the mortgage-backed securities. So their assets are going up. So assets and liabilities are going up stair-step with each other, and it's pretty much these excess reserves. So it's like, and I'm stealing this example from Jim Paulson, give credit where credit's due. He says it's like the Fed taking the drawer. They're at the Fed desk, and they pull up open one drawer of the desk, and they take out hundreds of millions of dollars, and they pull it out, and then they open the bottom desk drawer, and they put it in there, and then they close both desk drawers. So have they really done anything? No, they really haven't done anything, but that's really what's happening. They're buying treasuries, and they're giving banks liquidity, and then the banks are like, well, we don't want this liquidity. We're not loaning it out to anybody, so we're going to give it back to you as excess reserves above and beyond our required reserves, and it doesn't create any economic activity. So that's really where we're at with quantitative easing. That's why folks reference pushing on a string. The Fed can print money and print money, but if it's not getting into the system, then it's not going to create any inflation. It's not going to create any economic activity, and that's why there's a lot of skepticism on what the Fed's doing. And there's a lot of folks out there who want them to taper and want them to get rid of this QE quicker or sooner rather than later. Now, with that said, it does concern me, the tapering, because every time in the past 4 years that the Fed has stopped quantitative easing, we've seen a pullback in markets. It probably isn't from anything that they're doing. It's more psychological than anything else. But if they do it again, and they have been doing it, markets probably will be volatile. Now, the economy is a lot stronger now than it was 2 or 3 years ago, so that's going to help us get through this, but we need to take our medicine. And that's this taper. We're at 65 billion. We were at 85. They dropped it 10. They've dropped it another 10, so now we're at 65. If they keep dropping it by 10 million per meeting by September/October-ish, we will have been done with quantitative easing, and they'll have to start tightening. That'll be the next phase. They've kind of projected to the markets that they really don't want to tighten. They don't want to increase interest rates for a prolonged period of time. Depending on what the economy looks like throughout this next period of time is going to dictate whether they stay on track with the $10 million taper every meeting, or if they change that philosophy. We're going to want to keep a real close eye on that. Any changes in their philosophy and their program is definitely going to be market moving, either positive or negative, and we want to make sure we keep an eye on that. Unfortunately, there's a lot of people who look at the Fed and they make investment decisions based on what the Fed's doing. So it does drive short-term prices, but long run, we believe the Fed is a very non-important, it's more of a psychological issue than a true economic issue. And the velocity of money still remains low, like I said previously. Credit conditions, like I said, banks haven't really been lending out. I want to point out this slide here. This is from 34 to current. We've got common equity as a percentage of total assets. So common equity, think of that as safe assets to total assets for banks. We're at levels we haven't seen since the 30s, since the Great Depression. So banks have learned their lesson from the financial crisis. Now, it doesn't mean that they can't get greedy again. It's just they've definitely learned their lesson for the next 100 years. Probably be a while before we have some type of banking crisis because of this. Because of the conservative nature of how banks have been acting more recently. Credit conditions, the average credit score is higher than it was for approved mortgages. You can see mortgages have increased a ton, so we are seeing some movement in the housing sector, so that's positive. But banks, for the most part, are being very conservative. Residential mortgage delinquencies are going down, consumer loans delinquencies are going down, and commercial and industrial loans delinquencies are at very, very low levels. So, we're looking at this and we're keeping an eye on this, but banks have been pretty conservative during this period of time. High yield bonds are starting to not look as attractive as they were. High yield spreads to treasuries, we average 5.9, so we're getting 5.9% higher than a treasury of the similar length and time. We're at 4.4 right now. Leveraged loan spreads, these areas are very popular right now because there's so many, our fixed income space is limited on where we can look for yield advantage or credit advantage or short duration. And so these areas have been piled into. I'm a little concerned with some of these bond sectors, and we've made some adjustments. We've done some rebalancing to the portfolios, but high yield, although it's going to give us a yield spread advantage, at 4.4% spread, that's not really paying us for the risk that we're taking. Now, to counteract that, default rates are at historic lows. So you've got default rates at 0.7%. That's very, very low. But we definitely want to keep an eye on this area as well. What we see in 2014 is very similar to what we saw in 2013. We believe the economy is going to improve, which means interest rates are on the way up. For the year end, our target is somewhere between 3.5% and 4% on the 10-year Treasury. Right now we're at 2.7, so let's say that we're on the low end of that. We're looking at a 90 basis point to 100 basis point 1% move in interest rates. So if we look at this, okay, well, the price impact of a 1% rise or fall, we're looking at a 1% rise, so we're on the left side of here. So a 2-year Treasury, if we have a 1% rise, well, the price of a 2-year Treasury is going to drop by 2%. 2-year Treasuries are yielding roughly, let's call it 2%, 1 to 2%, 1.5%, let's call it. So you earn 1.5% as interest, and you lose 2%, so you're down 0.5% for the year. That's how you're looking at these things. 5-year Treasury, we've got a little bit more price movement with the 1% rise. 30-year Treasury, we have a huge price movement, and then you can kind of see floating rate, convertibles, high yield, some of these other areas, and how they react to a 1% increase in interest rates. I only bring that up because we're in a similar situation than we were in 2013. We weren't very optimistic with bonds. We've got to have them in the portfolio to keep the risk profile from being compromised, but we definitely want to own the correct type of fixed income. Shorter duration, get a little bit of yield advantage. However, with that said, with the high yield being at historic lows and leveraged loan spreads being at historic lows, we want to be careful of those bonds too. So bonds, it's real hard in bonds, but we have to have them. We have started to use a lot more of these short-term, safer bonds where if we do have some price increases, we won't see as much negative impact on those. But in the same breath, we're not going to earn a lot from those places either. They're really just to protect our equity holdings in case we have a bad year in equities. We need some safe assets, some dry powder that we can get to work if we were to see a pullback in the equity markets. Correlations between weekly stock returns and interest rate movements. I've had this slide in here before. At low interest rates, you can kind of see a shift here at 4%. So once the 10-year gets to about 4%, we start to go more negatively correlated. But until then, an increase in interest rates usually means a positive relationship for stock movements. So that makes a lot of sense. Once we get to about 5%, that correlation becomes negative and it starts to have an impact. Increases in interest rates have more of an impact on economic activity than they have a positive impact. So that 4 to 5% is a very telling number there. That's that's when we're looking at probably PE multiples of 18, 19, 20, and that's when, from the very first slide that I put on here, that's when most people are going to be real excited, more greed than anything in the market, and we might have an S&P that's at a 19 or 20 multiple. That's when we want to start maybe looking at fixed income and saying, okay, this looks a lot more attractive than it did, back in 2012, 2013, 2014. But like I said, we're in the fourth or fifth inning, I think, and we do have some room to run on equities. We do see some positive implications here in the U.S. economy. It's definitely ticked up, so we want to make sure that we pay attention there. International is a lot different than domestic. We haven't seen the improvement in international stocks like we have in domestic stocks, and you can see the valuation metrics are a lot more attractive internationally than they are domestically. We're getting a PE multiple of 13 for developed international. We're getting a dividend yield of almost 3 with some upside. So, international is definitely a place that we're wanting to overweight right now. There's a lot of headline risk. It might not be the bottom right now. We still might see some downturns in international markets, but when it's all said and done, we believe there's more opportunity long run in some of these areas and emerging markets included than there is domestically. So we want to put a little bit more emphasis on our international holdings. And hey, if we don't go anywhere, well, we're going to be earning almost 3% to stay there. So that's not bad. This is just another way to look at it. This is returns to prior peaks. So to get back up to this 1212 number, the EFA has got to return 30% in 1 year, or over a 5-year period, it's got to return 8% from its December 31st, 2013 levels. So definitely an area that we want to be in. Once again, emerging markets is also a very positive area. 2009, emerging markets did really well. 2010, 11, and 12, and 13, emerging markets really haven't done much at all. In fact, they're negative over that period of time, mostly because earnings haven't been great in emerging markets, but their growth is still the highest in the world, and we expect long run the returns from those areas of your portfolio to be the highest, the most volatile, but also the highest returns. You get paid for that extra risk that you're taking. Emerging markets definitely has the most risk out of any piece of our portfolio that's there, and we've been tippy-toeing extra weight into emerging markets as we've seen more opportunities. Manufacturing momentum, these are market PMI numbers. You can see that there's a lot more green on the screen versus 2012, where Europe was in a mess, double-dip recession. We're starting to see a little bit more positive, some green numbers throughout. These are very important numbers. These are leading economic indicators. That's why, back a couple weeks ago, China came out below 50, which means contraction, and people start to get worried, and then that leads to some of the smaller emerging economies having liquidity crisis, and it all is relative to each other. And then we have some slow data in the U.S., and in a month you see global equities down 6 to 14% if you're talking about Japan. So it can definitely move markets, these market PMIs, but for the most part they're improving, and so that's why I have this slide here, to show that we are starting to see some improvement in a lot of these economies, and that's a very positive sign. Another reason why we're pretty optimistic about more aggressive assets. Europe, another positive we have in Europe is that they did go through a double-dip recession. They decided that it was more important for them to go through austerity, and they decided to go the route paying now for longer-term growth later. The U.S. decided, hey, let's stimulate the economy with some tax benefits and a fiscal package and some monetary stimulus. So that was the U.S.'s take. if we were to look at who was more successful, you could probably make a real good case that the U.S. way was more successful in the short run. We're still yet to see which is going to be more successful over the long run. But the reason that I have this chart here is, one, to show that Europe went through the double dip. They took pain now versus pain over a longer period of time. And here's the fiscal drag from 2010 to 2013 is in gray. The fiscal drag from 2013 to 2016, the estimates, are in purple. And so you can see that for the Eurozone as a whole, 3% drag all the way down to a 1% drag. That's going to be a tailwind for stocks in the EU. And so that's one of the reasons that we're more optimistic. But with Europe comes a lot of headline risk. We did go through a double dip recession. They have gone through austerity. So, you know, there are opportunities there, but we definitely want to be careful with where we're going and how we're adding it to the portfolio. Valuations, you know, based on what I've said so far, it's not a surprise that developed nations, the EFA index, the United States. Now, this is as of the year end, so these have improved a little bit because of the sell-offs, but we're in the camp of more fairly valued than we are undervalued in the developed world. A little bit different now that we've had the sell-off, but let's just, for sake of argument, let's say we're about fairly valued in the developed markets. Emerging markets, we are undervalued. If we were undervalued before, at the end of the year, now with some of the stuff that's happened in emerging markets, prices have come down. That makes them more appealing, more attractive, and you can see that on an entire basis, EM is undervalued, and then you can look at specific markets, especially the BRIC nations, and see that they're real undervalued right now when you look at historic perspective. Hey, they go through the same thing that the United States went through in 2008, 2009, when everybody was despondent and that emotional roller coaster. Emerging markets go through it as well. People don't want to invest there when there's blood on the street, but remember, that's when the profit is the most, the profit can be the most, the potential for maximum profit is the most when there's blood on the street. So that's why we want to tippy-toe into some of these markets with some of our risk budget inside the portfolio. Yield alternatives, domestic and international and global. We can see dividend yields for the U.S. are a little bit lower than they are throughout the rest of the world, and then the corresponding 10-year government bond yield. The U.S., you know, there's been an increase in the U.S. because of that economic growth. We've seen that. These other countries, they haven't seen as much economic growth yet, and so their 10-year Treasury equivalents, 10-year government bond yields, still haven't even gotten to the level that their corresponding dividends on their stock markets have. So just wanted to point that out. We have some pretty good dividend yields internationally. Global REITs, you know, we're getting paid in the global REIT sector. There was a little bit of volatility in 2013, but for the most part, we're getting paid a pretty decent dividend comparison to the 10-year government bond yield in each of these countries. So there is a reason that we want to own REITs in the portfolio. You know, they didn't do so well in 2013, but there's definitely a long-term reason to own REITs inside the portfolio. They're a very good hedge to the rest of your portfolio. They don't really act like the rest of your portfolio, and they give you a pretty decent income. So, you know, a lot better than where we would be at if we were sitting in cash. Cash is not earning us very much money. A $100,000 investment in a 6-month CD for 2013 would earn us a whopping $270. That's not great. We still have cash levels that rival the 2002 recession. Folks are still sitting on cash. And you're starting to see people get it invested a little bit more. You're starting to see a little bit more investment with some of these cash positions. Folks are starting to let the reins down a little bit, but we're not near where we were in 1999 and 2000, where stocks were going up 100% a year. and people did not want to have cash at all, even though $100,000 was given you in a 6-month CD in the 90s was giving you a much better return than it is now. So this money's gonna have to start. I mean, people can't just, if they have investment goals, if they have to live off of their money to retire, or if they have certain goals, they're not going to be content, or they're not going to get the job done earning $270 on $100,000 for very long. And so they're going to have to put that money to work. Do they want to put it in bonds? Nah, probably not. Do they want to put it in stocks? Maybe they're starting to tiptoe in those areas. And we can see it clear as day here in these two charts here. This was 2007 to 2013, the beginning of 2013. Everyone was putting money into bonds. Bonds were doing very well. Interest rates were coming down. Bonds did very, very well. Now, in 2013, stocks were pretty much flat, the fund flows. Now we've seen exact opposite. People say, okay, well, I got my bond statements and I'm losing money in bonds. I don't know if I really want to be in bonds anymore. And so maybe they're tiptoeing into stocks. Here's the fund flows into bonds for the that previous 4 or so years, and now you're starting to see, okay, now stocks are exceeding bond flows. So this is a easy to look at. You can clearly see the relationship here. There's a lot of room for this transfer from bonds to stocks. This is just the very tip of the iceberg. One thing I did want to bring up here is for some of these big institutions, DB plans, pension plans, institutional investors who have to follow a mandate, if they started with a 50-50 portfolio, because of last year, stocks being up 30%, bonds being down 2 to 3%, a 50-50 portfolio after 2013, if they didn't do a rebalance the entire year, is now 60-40. A lot of these mandates say, hey, you have to get back to 50-50. So what do they have to do? They have to sell stocks and buy bonds. So this January slump, not only have we seen a little bit sluggish economic numbers, but we also see this rebalance. You can see why we've had a pretty volatile January and so far beginning of February. Tomorrow, we're really wanting to see some good jobs numbers so that we can kind of put some of that to bed. We're starting to get a little bit, like I said, it's not like 2010, 2011, 2012 where it was clear to me as a portfolio manager where we wanted to be. It just was really hard to get people there because we had gone through such a horrific recession. It's really hard for somebody to buy equities when they were down 40% in 2008. It just is. It's human nature. But if you look at where we've had the most opportunities, back in 1999, this is a huge gap where stocks, the earnings yield was paying us much less than a BAA rated bond. And so here it was really hard to invest in bonds that are yielding 8% when everyone, your friends, your family, are talking about the stock that they picked that was up 100% last year. So, it's human nature. These are times when you can see it, but it's very hard to do what maybe you should do during those periods of time because there's so much emotion wrapped into it. Right now, we had that exactly opposite with stocks being the more attractive thing versus bonds. Now we're starting to get back to, okay, we're going back to normal and where bonds and stocks are better. We still are favoring stocks in this environment. Still have some work to do. Some negative impacts from increasing in interest rates, we believe, in bonds. But this kind of gives you the story. Over 1 year, it doesn't really matter what the PE multiple is. The return for the preceding 1 year is all over it's random. But if we look at the PE multiple and then we look at the next 5 years, we get a lot better idea of what is going to happen. So we're at about a 14.5 multiple, which puts us right about here. That gives us, let's say about a 10% return if we're using this regression analysis. Now, there have been times when we've had PE multiples that we didn't get as much, but there's a lot of times when it's way above that. So, you just get a little bit better idea if you look at PE multiples. The next 5 years ought to be you get a better idea of where they're going to be versus the next year. So we don't know what 2014 is going to bring. It could bring anything, and that's why we make sure that we have asset classes that are going to do well no matter what happens in the economy, so we can make sure we're rebalancing and hitting our clients' long-term goals. With that said, we do favor equities slightly over bonds, and here's some. I guess I'm going to paint a picture for the next 5 years for the S&P 500. So you can see Q2 2007, we were at $24 a share for the second quarter for the S&P 500 earnings. We went through a huge recession and a huge recovery, and lo and behold, we're at new all-time highs, $27 almost for the third quarter in 2013. We're doing this with a very good profit margin, but folks are saying, well, the profit margins are really high, they've got to come down. Well, we're doing it with a leverage ratio that's really low in comparison to historic levels. So I'm not necessarily convinced that this profit margin has to decline, because companies will start to get greedy and they'll start to hire and they'll start to use leverage a little bit more than they are now, and they'll start to keep profit margins a little higher, and then your quarterly earnings per share will keep going up. To put it on more of a perspective, we got fourth quarter here. If we annualize it, we're at $120 per share with low interest rates. If we say, okay, well, earnings continue to grow at low single digits for the next 5 years, earnings can be, they can get up to about $135 very easily if we were to go out 5 years. If we were to say, okay, PE multiples are going to expand some more, we're going to have an expansion in economic growth. People are going to feel better. The pendulum's going to go more to the right versus more to the left. We're going to continue this momentum. And let's say that we get to a PE multiple of 20 with a $135 per share S&P. You could paint a picture, and I've heard economists paint this picture of a $2,700 to $2,800 S&P 500 in 5 years. Now, for every economist that I've heard say that, I've heard other more pessimistic economists. So we don't know quite where we're at. I would probably tend to be on the side of more optimistic S&P numbers and international numbers versus pessimistic. And I would say that there's a very factual-based argument to be made that the S&P could be at 27, 2,800 in 5 to 6 years. With the projection that we're on now. With that said, we never know what's going to happen tomorrow. Anything can happen. China could have a hard landing. Something that no one sees could pop its head up and cause housing to go back into a double-dip recession, the U.S. to go into a double-dip recession. We don't want to abandon any one of our asset classes, and so we want to make sure that we stay diversified so we can keep our risk down and still keep our return high. And we really want to make sure that emotions don't play into the decisions that we're making, because we don't want to be the average investor who earns 2.3% over the last 20 years. We want to be the investor who holds bonds and holds stocks and holds REITs and holds international and gets somewhere in the middle of these returns by staying the course, not making emotional decisions, and having a long-term plan. I've talked about this slide before. I love ending with it because it comes down to in 2009 and 2008, some people had the wrong time horizon. They were in the market for a short period of time, or they were going to get ready to retire, and they just didn't have the propensity to take risks, but they were in the wrong type of portfolio. And in 2008, they lost 37% of their portfolio instead of maybe a 50-50 portfolio where they would have lost only 15. Now, 15 is still a lot, but it beats 37 when 37 is the alternative. If we had the right time frame, meaning you set things up a little bit different, you're not maybe as greedy and don't need to get everything invested in stocks, but we build a more diversified plan where we don't need to start pulling from this part of the portfolio for 5 years, well, now we can put the odds in our favor. You know, with a 50-50 portfolio, we've never had a 5-year rolling period over since 1950 where we've lost money in a 50-50 portfolio over a 5-year rolling period. And in fact, the best 5-year rolling period has been up 21%. That's pretty good. If we push this out to 20-year rolling, now you're looking at even better numbers, and we can put more into stocks if we have a longer time horizon. This graph is just to show you the importance of your time horizon. It is it's not a very good thing for clients or for Ironwood to put somebody in a portfolio that's way too aggressive for 1 year and have them lose 37% only to have them sell at an inopportune time and then lose money and no longer be a client of Ironwood. We haven't done them a favor, and we haven't done ourselves a favor. So we really want to hammer home with this. We want to have the right time frame for our investment objectives. And then this is another one that I really enjoy. 2013, our biggest pullback was 6%. We've already seen that in January. 2013 was the aberration, not 2014. 2014 is more normal. 2013 was a very unique year. We went up pretty much the entire year until they announced QE3. They were going to start to slow down QE3. We had a little bit of a dip in the middle of the year, but we rebounded very nicely with some positive economic data. You can see that typically we have a much more volatile market. In fact, inter-year drops average 14.4%. So last year our inter-year drop was 6%, less than half of what it normally is. We would expect at some point in the year to have a 10 to 15% drop. Even with that said, 26 of the 34 years, we end up positive. So the stock market is volatile. We can't get used to 2013 where we saw nothing but up, 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 up. That doesn't happen. We need to focus on risk. It's not just about return. It's about risk and return, and those two things together, not just return. So we want to make sure that we're focused on that as well. With that said, what are the investment implications? These have changed a little bit since the last time we talked. We've got domestic equities down here as our underweight, and we're kind of moving that into international, some emerging markets, getting more into commodities, some real estate, floating rate bonds. Not as much pounding our fist on the table as last year. Market neutral looks a little positive, but things that we still would continue to underweight: fixed income, long duration, most treasuries except for very short-term treasuries, and then, like I said, it's not a huge underweight in domestic equities, but what we've done is we've taken a little bit of our domestic equities and put it into some emerging markets and some developed international. So with that, I'm going to end it with the last 10 years of returns. We have cumulative return of over 100% for the last 10 years from the asset allocation portfolio. Now, this asset allocation portfolio is more of a 65% aggressive assets, 35% safer assets, but it's so it's more on a moderate risk scale than maybe some of our retirees, but it still gives you an idea. 7.2% annualized for the last 10 years with a huge recession in the middle is not a bad return. We'd be okay with 7.2% annualized return in a 10-year period. That would be very positive return, and we'd be happy with that. So with that said, I'm going to go ahead and open it to questions. I'm going to have Nick look at the questions, and he's going to go ahead and lead the question and answer session.
Okay, I've got a good one here to start with. And we certainly invite any of the panelists or meeting attendees to go ahead and type any questions or comments into your webinar panel on your computer screen. Considering the amount of cash that has been pumped into the global economy, Sean, what is your outlook on the potential for inflation or deflation of global currency and its potential effect on commodities?
That's a great question, and I tried to hit on this. I probably didn't do a great job with my Fed slide. So I'm going to go back to that Fed slide here. Actually, let's go. Well, I think it's in here. Come on. So there is definitely a lot of liquidity. And on the margin, it's not really having that much of an impact in real economic terms. And that's because this money multiplier has gone from 9 to 3. So banks aren't lending. We don't see a lot of economic activity that's coming from, and this is just looking at the U.S. We could add several central banks on here, and this is the story around the world. Until we start to see economic activity pick up, we're not going to see inflation. Until we start to see job wage growth, wage increases, we're not going to see a lot of inflation. I am concerned with when we do see economic growth, a spike up in wages, and then inflation to follow. And it's going to be really hard for central banks to pull it back when they've got all of this extra liquidity out there if banks start to send it out. But if that were to happen, we would most likely have a spike in inflation, and then it would cause possibly a recession down the road. Now, with that said, economists who predict recessions or who try and forecast recessions are usually they're right 9 out of 7 times. So they predict them way more than they actually happen. And I'm not saying that we're going to have a recession, but that would be one of my concerns for the future is, and with the global central bank system being as liquid as it is, I'm not so concerned with the smaller emerging economies. They're really not that important, especially to the U.S. economy. I would be more focused on the Eurozone and the United States and Japan, and really those big economies and how it's affecting them. And right now, with the velocity of money as low as it is, it's not that much of a concern for us. So hopefully that answers some of the questions on that.
Okay, as everyone can see here, apparently Bill Gates has joined our webinar. We feel very fortunate to welcome the founder of Microsoft to our webinar this evening. The question is here, Janet Yellen, what's her monetary view versus Ben Bernanke?
Ben Bernanke and Janet Yellen are almost the same philosophy, almost identical philosophies. I would say, if anything, Janet Yellen is a little bit more dovish. You know, this first meeting with her at the helm, it was nice to see that they stuck to their guns and continued to stop the taper by another $10 billion per month. But for all intents and purposes, I mean, she was the vice chair before. Now she's the chairman, chairperson, and it's really a continuation of Ben Bernanke's policy. They're really their views don't differ very much at all.
Okay, Sean, we'll proceed past the Super Bowl question. I think we've all understand the answer to that. And I think that the Denver Broncos are probably going to be looking forward to next year, another year of Peyton Manning. So we'll move on to the next question here. What's your take on? Could you further explain the notion of underweighting versus overweighting a investment portfolio, please?
Absolutely. And when I say overweight, underweight, what I'm talking about is if our benchmark portfolio, and I'll just use two asset classes to illustrate this. If I just use two asset classes, I'm going to use stocks and bonds. Very generic, very easy. Now, we have more asset classes than that, but if I'm in a neutral position and our investment policy statement says we want to have 50% in fixed income, bonds, and 50% in stocks or equities, then a neutral position would be to be at 50-50. We're not underweight or overweight either of those. If we're overweight, then that means we might, if we're overweight equities, we might say we're going to be overweight equities and we're going to put 52% in equities and 48% in fixed income. So that's what I'm saying is compared to the neutral position, we are overweight if we're higher than the neutral position, and we are underweight if we are under the neutral position. So hopefully that explains that a little bit better. Sorry if I breeze through that. It is a little confusing when I say overweight, underweight to what? What I'm talking about is our neutral stance or the neutral benchmark stance.
Well, we'll give a few moments here for any of our webinar panelists or meeting attendees to include any last moment questions or inquiries of Scene. But until that time, we'll probably begin to wrap up here. And certainly thank everyone for your time and attention this evening. And we certainly would invite everyone to attend our second quarter Market Insight webinar hosted by myself and with Scene as the keynote presenter. So until that time, we'll probably say good evening and thank you again. And we certainly look forward to having your time to spend together again for the second quarter of 2014 webinar presentation. So please stay tuned and be on the lookout for those invitations.
Thanks everybody for tuning in. We'll talk next time.